All right. Good morning, everybody. Good morning, all you magnificent melon heads. I hope you are well. 9 a.m. is here, October 5th, 2023. And the top story this morning, we finally have our first bank is wobbling of this recent spike in interest rates. Anytime you get this big upward lurch in interest rates, it's a good bet that there's a trouble brewing at some bank somewhere. And it looks like this morning we have our first candidate, if you will, Metro Bank in the UK. It's a relatively small bank, about $2.8 billion in assets, according to their latest balance sheet. They announced that they were trying to raise capital, that they're trying to issue debt, and that they were trying to issue new shares to try to raise about 600 million pounds, about $728 million of capital that they're trying to raise at this bank. By the way, shout out to my buddy Mario over at Moneco 64, the home of alternative economics and contrarian views. Mario led with this story this morning. He was one of the first ones on YouTube to pick it up and did a little bit of DD on my own. Sure enough, that bank is getting absolutely crushed this morning. Their shares were down as much as 29%, currently down about 25% on this bank. Now, the bank has not failed. I just want to emphasize that. I don't want to, be accused of fudding here. All they did was they said, we want to raise money. We want to raise capital, and the stock market is punishing them brutally. Now, the thing is, if they really desperately needed to raise money, if there's some big hole in their balance sheet, which, I went and looked at their balance sheet from June. It was a quick look because I didn't have a lot of time this morning, but it didn't look like there was anything glaring there, at least not in the few seconds I spent looking at it. Obviously, there's something lurking beneath the surface there. But if they desperately need that capital, this big decline in their share price means they might not get it because now they have to issue way more shares in order to get the same amount of money that they're trying to raise. Likewise, Fitch is now downgrading or placed them on ratings watch negative because of this big decline in their share price. So it may get more expensive for them to borrow, to issue bonds and try to borrow debt. So this news this morning is going to make it more difficult for them to raise that money. If they're unable to raise that money, I don't know what happens then, but obviously nothing good is happening at that bank this morning. Now, this is a UK bank. I'm not sure about the differences. Here in the States, we have the FDIC and the $250,000 limit. Anything above that is uninsured. I'm not entirely sure what the statutes are in the UK. It's a good bet. It closely mirrors what's going on here in the States. But you folks out in the UK, you may want to double check that on your own and just make sure you're protected and that you're insured. If you're anything over those levels, just be careful. Also going on, we had a massive drop in oil prices. And, I did an interview with Steve, who I met from a channel called In It to Win It. He's a guy I met at the Silver Symposium. We did a quick interview on the side. Nice guy. Hi, shout out to Steve. Check out In It to Win It. There's a link in my community page to that interview. And, I was kind of joking around because they were asking about commodities. Steve was asking me about commodities in that interview and said, which one do you like the most? And I said, right now, oil was interesting because what the Saudis and the Russians were doing, that it was basically going to offset the entirety of the Strategic Petroleum Reserve dumping from last year. And that barring any big demand destruction caused by a global recession, oil prices would head higher. And wouldn't you know it, Jack called the top in oil because that was like to the hour when he posted that interview was the top in oil. And now, we got that big demand destruction. We had the EIA reported oil inventories yesterday, but more importantly, gasoline inventories yesterday. And there was a 650 million barrel increase in gasoline inventories in the United States in the prior week. Massive inventory build. People just stopped driving everywhere. I don't know what happened in that one particular week. Was there a big surge in production at America's refineries? But the market saw that, and oil prices just absolutely collapsed. $5 per barrel in one day on the destruction of gasoline demand here in the States. RBOB futures, gasoline futures, just absolutely in free fall too. So it looks like that demand destruction is here, and oil prices are reacting strongly to the downside. Now, I've been mentioning that I'm looking for an entry point in oil for a while now. I'm still looking. I'm still waiting. I'm not going to try to catch this falling knife. I think price is probably still heading lower. But you've got two big forces at work here, guys. You've got massive demand destruction caused by recession, but you've got massive supply disruption being caused by OPEC. And last year, it was the supply that won. When the U.S. dumped all that artificial supply from the Strategic Petroleum Reserve on the market, that was enough to send prices cascading lower. What the Russians and Saudis are doing now is every bit as powerful as what we did with the Strategic Petroleum Reserve last year. But now we've got this big demand destruction. So we're right back in that, you've got two big forces pulling in opposite directions. Which one is going to win that tug of war? A week ago, it was the supply disruption. Today, it's the demand destruction is winning out. And with that, we are going to shrink my big melon of a head. And guys, while we're shrinking my big melon of a head, won't you please hit that big, beautiful like button and subscribe to the channel. We do this every day. I'd love to see you guys having your coffee with the melon heads tomorrow morning. And, geez, what's going on with StreamYard here? It's throwing me off. Looking over at the CNN Fear Greed Index this morning, we are still in extreme greed. Yes, 2 days in a row I did that. We are still in extreme fear territory this morning, albeit a little bit higher than we were yesterday at 23. That's up from yesterday's 17. But fear is definitely still permeating the markets this morning. S&P 500 is down a little bit, about 14 points lower, or 0.35%. Just want to point out this little red candle right here at 8:30 a.m. Eastern time today. That was when the U.S. released their weekly jobless claims numbers, initial and continuing jobless claims. They came in low again. The market did not like that. I think the market is looking for a surge in unemployment here, and it didn't get it. So it's possible that the market reacted pretty strongly to that. We did see a bump in interest rates and bond yields right around the same time we saw that drop in stocks. We have got let's take a look at this real quick. This is the S&P 500 looking at a long-term chart. We're going back to about July of last year here. And I want to zoom in right here, guys, because we're sitting right around that 200-day moving average. This is our support level here, 4,200, almost on the dot. We break below that on the S&P 500, we've got problems because there is no support until we get down into the threes if we break below that 200-day moving average. Now, we got close. If we zoom in a little bit here, we got close yesterday, that was on the 3rd, 2 days ago. And then we got a nice bounce. We'll see what we get today. Watch for this level to hold. If this level holds and we're heading higher, then we're probably going to start making our way back up towards this 50-day moving average. That'll be our next level of resistance. If we don't hold, then it is the elevator down for the S&P 500. It's going to follow interest rates one way or another. Looking over at the Dow, we got something similar. We're down about 98 points in the Dow this morning, 0.3% lower. And the NASDAQ is also joining in lower by about 0.25%, 35 points to the downside for the NASDAQ ahead of the opening bell. Looking at the U.S. dollar, it's down again this morning, 106.7. That's down another 10 basis points. The dollar's been on quite a tear lately. It looked like, I don't know if we got intervention by the Bank of Japan yesterday or not, but the dollar is a little bit weaker. And we'll keep an eye on this one here. Also, I'm seeing rumors that it may have been China that is adding to this spike in interest rates currently, that the Chinese may be dumping U.S. bonds. Also, that would put a little bit of downward pressure on the Dixie. Even though the DXY, the Chinese yuan, the renminbi, is not a contributor to the DXY math, if the Chinese were dumping dollars to buy their own currency, it would still send the Dixie lower, even though it's not a direct influence. Looking over at the bond market, we've got yields on the far long end of the curve are higher this morning. The 30-year Treasury is up 2 basis points at 4.90. The 10-year is down about half of 1 point, 4.727 on the 10-year. The 2-year is down by 1.5 basis points, 5.03 on the 2, and the 1 month is at 5.39, being held in place by the Fed in their overnight rate. Let's take a look at the long-term chart on the 10-year yield, because we've been in this pretty steady uptrend here, following the 50-day moving average for these last couple of weeks. I think we're probably due for a pullback here, guys. It does kind of looks like we may have put in a short-term top right there. I'm not sure if that one's going to hold. I would look for this 50-day moving average to act as support and then probably continue on this trend. We'll see what happens over these next few days here, but that was quite a substantial pullback from the highs that we saw yesterday. Although all the main players in the bond market, the Japanese, the Chinese, the Federal Reserve, they all remain sellers of U.S. Treasuries. So the only way we're going to see these yields drop, the only thing that can really save the bond market right now is if we sacrifice the stock market. Now, the reason I'm saying that is because the bond market needs cash. It needs money. We need people to come in and buy bonds in order to drive their prices higher and push these interest rates lower. Well, where's that money going to come from? It's not going to come from central banks. It's not going to come from the Fed. It's not going to come from China or Japan. Well, the only other place it could come from is, well, maybe a little bit of precious metals. You could see some selling of gold and silver. We're seeing that in these last few days. But it could also come from the stock market. If we get a sell-off in the stock market, people are going to be pulling their cash out of there. They'll be looking for some place to park it. When you're yielding 4.8 on the 10-year, 5.4 on the 1 month, bonds is a pretty good place to park your money. So if we do see some kind of a panic in the stock markets develop, that may give us the decline in bond yields that we need to head back lower in that area. Looking over at commodities, we got gold. December gold futures at $1,828. That's down about another $6.50 this morning, or a third of 1%. December silver futures at $21.06, fighting to maintain that 21 handle. They're down another 8 cents this morning, or 0.4% on silver. WTI crude down another $1.45 this morning for those November futures, another 1.7% lower, trading at just $82.79 this morning. Now, we got a couple of charts and commodities I want to look at. First of all, check out gold here. A couple of days ago, how did I miss this one? Look at that big, nasty death cross in the long-term gold chart there, the 50-day moving average crossing below the 200-day moving average. And as soon as that happened, look at what the price of gold has done. Down, down, down. We're due for an update in gold, guys. What do we got? 1, 2, 3, 4, 5, 6, 7, 8, 9 days in a row red on gold. If you're looking for a swing trade, that might not be a bad option. If we do get that drop in interest rates, we might see gold prices do pretty well in that environment. We're certainly due for it. 9 days in a row, red candles on the gold chart. And the silver chart looks the same. Let's zoom in again. There it is. There is that big, nasty death cross again on the silver chart. The 50-day moving average moving below the 200-day. Not quite as ugly looking as the gold chart. We had one little green candle hiding in there, but still, I think silver's due for a bounce here. But the big story in commodities is oil. Check this one out. Oil prices attempt to recover after the bullish bubble appears to burst. That's some strong language being used in oilprice.com this morning. After the bullish bubble appears to burst, oil prices dropped by $5 a barrel on Wednesday in what appeared to be a significant shift in sentiment following a 3-month rally. And man, didn't Jack just call the top in oil when he said oil was his favorite commodity in that interview over at In It to Win It. Couldn't have timed that worse, huh? The EIA's latest inventory report was the spark that ignited the crash, with gasoline inventories climbing by 6.5 million barrels and demand falling dramatically. Just before prices crashed on Wednesday, OPEC Plus agreed to maintain its production cuts. That's a move that should have put upward pressure on oil. So right now, demand destruction is winning the narrative when it comes to oil prices. We got some serious gasoline demand destruction. Check this out. This is the EIA number, the data that got released yesterday. Stocks of gasoline in the United States increased by 6,481,000 barrels in the week ending September 29th. It is the biggest increase since the first week of January 2022, following a 1 million barrel gain in the previous period. So here's the chart, guys, of oil inventories. You can see, yeah, we usually get this bounce up and down. But then look at this monster inventory build here, almost 6.5 million barrels of gasoline inventory. And we got Carl Quintanilla over at CNBC. He's talking this morning saying falling wholesale gasoline prices imply an approximate decline of 12% in retail gasoline prices coming in the coming weeks. That's from its current level of $3.79 to roughly $3.34 per gallon. So he's linking to a chart here. Let's blow up this chart a little bit bigger. It might be a little grainy, but you guys get the idea here. They're showing wholesale gasoline futures. That's them shown, I believe, in green. And then the blue line is your retail gasoline prices. And you can see, obviously, the retail gasoline prices, they tend to make smaller moves than the wholesale prices. But wholesale prices leads retail prices when you get a big drop like we saw back here in 2020. When you get this big drop in wholesale prices, retail makes a smaller drop and it takes longer, but it does follow suit. And what we're seeing right here in our more recent history, here's this big drop in wholesale gasoline prices by a couple of bucks. We saw, well, a couple of pennies. It was a $5 drop in oil prices. That means this blue line is going to be dragged lower. So at the very least, we have some cheaper gasoline on the horizon to look forward to. I know people will take whatever break that they can get. And this is the other big story going on this morning, probably the biggest one, the story. Metro Bank plunges on talk of big fundraising to fix finances. This is just this morning, 6:30 a.m. Again, shout out to Maneco64 who spotted this one this morning. Thanks, Mario, for doing that video. The bank is exploring options to raise as much as 6 million sterling, reports. Could include over 100 million sterling from selling shares. Shares dropped as much as 29%. Metro Bank shares plunged more than 25% on Thursday following reports that the British lender was exploring options to raise as much as 600 million pounds, that's $728 million, in debt and equity to bolster its finances. Shares in the bank have lost about two-thirds of their value since mid-February. As of Wednesday's close, the lender, which reported around 15.5 billion pounds in customer deposits at June 30th, was valued at 87 million pounds. So it looks like, guys, I apologize. Earlier in the stream, I had mentioned that I thought this bank only had 2.8 billion pounds. Apparently, that is way off base because this Reuters article is saying 15.5 billion pounds. So I apologize for that. Disregard that earlier comment about the size of the bank and the number of assets. I'm going to have to do a better deep dive on their balance sheet and see what's going on there. But still, 15.5 billion pounds. It's a small bank relative to some of the several $100 billion GSIB banks that are over there. So this is a small bank. It's not a huge deal. They have not failed. They're just doing a cap raise. They're trying to raise money to fix their balance sheet. The market is seeing that this bank needs to raise money. They're interpreting that as a sign of weakness. And so shareholders are dumping the stock. Here you can see this stock is down 27% right now, $13.70 lower, trading at 36.80, ticker MTRO.L. I guess this is an overseas company, so hence the .L. But it's not just the stock that's getting beat up this morning. Check this out from Fitch. This is dated yesterday. Fitch places Metro Bank Holdings on Ratings Watch negative due to capital constraints. Fitch Ratings has placed Metro Bank Holding PLC's long-term issuer default ratings and viability rating on Ratings Watch negative, or RWN. Fitch has also placed MBH's operating subsidiary, Metro Bank PLC, on Ratings Watch negative. MBH's senior unsecured bond and Metro Bank's senior debt program and Tier 2 bond ratings have also been placed on Ratings Watch negative. A full list of rating actions is below. The Rating Watch negative reflects our view that short-term risks to MBH's business model, stabilization, capital buffers, and funding have increased. We expect the group's earnings prospects to come under pressure in the short term due to rising funding costs resulting from higher competition for deposits and given likely more expensive access to wholesale funding. So they're saying this bank is probably going to have to go to the debt market, borrow expensive, high interest rate debt, maybe from the Bank of England, maybe some kind of a rescue plan like the Bank Term Funding Program or the discount window here in the States. Those always come with high interest rates attached. So this bank is probably going to take a big hit to its earnings in the future here. And it is, let's see, what else did we say? In addition, capitalization is tight, which in our opinion will require the bank to optimize its risk-weighted assets. This increases execution risk and curtails the bank's ability to grow its business and strengthen its profitability. So nothing good happening at Metro Bank. And guys, maybe you couldn't have predicted this exact bank and this exact thing would happen, but we could have seen this coming if you looked at this chart. This is the chart of the UK's 10-year gilt. This is their 10-year treasury bond, the equivalent. All right. And back here, I've got this horizontal line drawn in red here. Back here, this is where we had the UK pension system almost blew up back last fall. In the middle of the night, the Bank of England had to start printing money and bailing out the UK's pension system. Now, that was over this liability-driven investment tactic that the pension funds were using, and they were caught off sides. They didn't hedge their interest rate risk appropriately. It's a different failure mode, but it's the same thing. High interest rates cause problems. When interest rates rise too far, too fast, banks and other financial institutions are caught off sides, and they have to do something to solve the problem. And you could have predicted this because, well, look what's going on up here. We're right back at the same level. Now we've been there really since May, a couple of months bouncing around this level. It was only a matter of time before something started to break. Now, Metro Bank isn't broken already. They're kind of making noise over there. They're telegraphing weakness. But if these interest rates stay where they are, or God forbid, if they go higher, you're going to see more of these When interest rates go higher, bond prices go lower. And what have the banks bought with all of our money? They bought bonds. They gave out loans, which functions the same way as a bond. These interest rate increases are killing small banks, and their bigger cousins are just gobbling them up. Also this morning, we've got initial jobless claims came in. Low initial jobless claims again. The number of Americans filing for unemployment benefits edged higher by 2,000, so it's up a little bit, but still at a very low 207,000 on the week ending September 30th. That's below estimates for 210,000 and remaining close to the 7-month low of 202,000 from earlier in the month. In the meantime, continuing claims unexpectedly fell by 1,000 to 1.664 million on the week ending September 23rd, well below estimates for 1.675 million and remaining close to the near 8-month low recorded previously. This is suggesting that unemployed individuals are having relative success in finding new jobs. The data added to evidence that the labor market remains historically tight levels, pointing to added resilience to the Federal Reserve's aggressive tightening cycle and adding leeway for rates to remain higher for longer. There's that phrase again, higher for longer. And this is another one of those good news equals bad news scenarios. We got fewer people than expected filing for initial jobless claims, and that has the market saying, oh boy, the Fed's going to hike again, even though interest rates are doing what they're doing. Remember, the Fed's goal is to put people out of work here, guys. They're not going to tell us that, but that's what they're trying to do. They're trying to hurt the economy enough that people lose jobs so wages don't rise and inflation stops. That's their tactic. Isn't that nice of them? After devaluing all of our savings through their money printing, which made them rich at our expense, now their big solution is to put us all out of work, for our own good. You got to love central banks, folks. But, it's okay because every time they talk about how they're acutely aware and they're highly sensitive to the pain and the plight of the common person. So, they're just regular guys like us, right? And we also got the big drop in U.S. continuing claims here. Continuing claims in the U.S. decreased to 1.664 million in the week ending September 23rd. Again, continuing claims very low here. If the Fed is trying to reduce tightness in the labor market through their rate hikes, it's not working. They're certainly reducing tightness in the health of banks. But when it comes to the job market, they're not yet having the effect that they're trying to have, which means, guys, higher for longer. And I just have to mention, I don't know what it is that the market is looking at, why they don't believe Jerome Powell. But check it out right now. This is the odds of a rate hike in November, currently sitting at just 20.4%. The entire bond market is still positioned for the Fed to do nothing in November. I don't know what they're looking at because everything I look at, everything I hear from the central banks, including these most recent jobless numbers, they all tell me the Fed's going to hike in November. The bond market, despite this rise in interest rates, they're still off sides. They're still betting that the Fed is done here, even though the Fed has told us they're not done. Maybe they hike in November, maybe not. But this 80-20 split in the CME futures market, nope. At best, it should be 50-50. So that tells me interest rates could still rise further because the bond market is still not quite getting this one right. And for whatever reason, guys, I'm having a hard time getting StreamYard to behave here. Let me see if son of a gun, I'm not able to bring up these super chats. I'm going to hit refresh. I hope this doesn't end. No, I can't reload it. Son of a gun. Guys, I can't bring up the super chats on the screen this morning. Something happened with my streaming software. So I am not able to bring that up here. Let's see what happens if I do this. Maybe it will. There we go. We snapped out of it there. I can get to the comments. Can I get to the starred comments? I can. All right. Manuel Barrera, thank you, sir, for the super chat and the support of the channel. He says, great video last night. Looking forward to seeing that electronic thrust engine. Thank you, Manuel. I appreciate that very much. He's referring to that interview I did with Kirian Von Hest yesterday, a.k.a. Deso Games from Twitter. And thank you for the kind words and the support of the channel, Manuel. And thank you, Kirian. What a fantastic job Kirian did digging into that MBB ETF, that mortgage-backed securities ETF. I released that one late last night, guys. It took me forever to get all the editing and everything done at the last minute. I had a busy day yesterday with my Patreon Zoom, so I wasn't able to get it posted till later. But if you haven't seen that one already, it's a long video. It is worth the time. What an incredible find Kirian made. Everything inside the largest mortgage-backed securities ETF in the market has been downgraded. The whole thing, every single mortgage bond inside the MBB ETF was downgraded from AAA to AA. And I don't want to spoil it, but I think we figured out what caused it. But long story short, guys, the banks are doing the same thing they did during the GFC. They are rubber stamping AAA, things that are not AAA, high risk, horse manure debt. And they're saying AAA rated. They're putting it into bonds. They're putting those bonds into ETFs, and they're selling it to unsuspecting retail investors. And Kirian, he went deep into that DD. He actually clicked and he actually looked at what was inside the fund. Amazing. What a concept for people to understand what they're buying. And what he found in there will not disappoint you. Highly recommend you check that one out. And thank you, Manuel. I appreciate that very much, sir, for the super chat and the support of the channel. And thank you to the Nashville Pasta Man. I appreciate that, sir. He says, between the net asset value piece you did, which was absolutely spot on, and the mortgage-backed securities downgrade, you're doing great work. Well, thank you, Nashville. I appreciate that. He says, I'm having a garage sale. I'm not going to sell anything. I'm going to take a loan against the value of what's in my garage. Now we're thinking outside the box, Pasta. Let's do net asset value financing for the crap in our garage. Let's just borrow against it. Let's use the money we borrow against the crap in our garage to make ourselves feel rich. We'll go on vacation. We'll show off to our neighbors. We'll get flashy new cars and everything. But really all that is leveraging the crap that's in our garage. That is some serious outside the box bank-like thinking from the Nashville Pasta Man this morning. Thank you very much, Pasta, for your kind words, for your creativity, and for your support of the channel, sir. I appreciate that very much. I got a laugh out of that one. And Kevin DeBella is here also this morning. Thank you, Kevin. He says, great video last night, but terrifying. I agree. It was scary. And again, Kirian did a fantastic job on that. He says, when the reverse repo runs out, it's Armageddon, ? Armageddon might be a strong word. I mean, let's not automatically write them off. Maybe they just change the rules again. They do something so sleazy that, if there's one thing I do routinely, it's underestimate how sleazy these people are. So maybe they just rewrite the rules at the last minute to bail themselves out at our expense, something we haven't guessed or something we didn't see coming. So maybe they are able to avoid Armageddon at least right away. But if they do that, what they will do is make things worse down the line for everybody. So eventually Armageddon is coming. Financial Armageddon, right? Not asteroids, fire and brimstone, dogs and cats living together. But it's coming and it feels close, guys. The reverse repo is dropping. And when that gets to zero, there is no more cushion left. There's no more liquidity left. And right now they're draining that puppy at a really fast clip. And based on the numbers I'm seeing and what Kirian said, it looks like we got about 6 months before that gets to zero. And I don't want to find out what happens when that gets to zero. Maybe our elected officials and our financial system will come to its senses before that happens. Hey, stranger things have happened. I just throw them out there. You guys do what you want with them. He says, so either inflation goes up or the economy goes boom. What's your ETA? Yeah, I agree. I still don't know which one. That fork in the road is still ahead, and I can't see past that fork. But my ETA is about 6 months for the reverse repo to run out of cash. And when that happens, you want to be in cash. Or at least that's what I want to do. I can't tell you guys what to do with your money. That requires a permit from the government that I don't have. But I can tell you my plan is when that reverse repo runs out of cash, my plan is to be largely in cash. I want to have what is in short supply and what everybody else will desperately needs. And when the reverse repo runs out, cash will be it. So that's my plan. And my best guess is we've got about 6 months. But, we can see that chart in broad daylight, so we'll have plenty of warning before that gets here. Thanks again, Kevin DeBella. Thank you, everybody, for the super chats this morning and the support of the channel. Thank you to my Patreon supporters for everything you guys do for the channel. Had a great time talking with you yesterday. Go check out that video with Kirian Von Hest on my feed. Kirian, you did an amazing job with that if you're listening, brother. Also, I got to say, hi, Mom. Hi, Dad. I love you guys. And everyone, till next time, live small and dream big.